Welcome to Markets Now. I'm Michelle Work with Randy Martinson, Martinson Ag. On the last trading day of 2023, we ended with just about everything lower. And Randy, it really felt like this week we saw a lot of end of the year type positioning and money flow influencing trade.
It did. I mean, it was pretty quiet. Our trading ranges were tight, and it just didn't seem like we were getting anywhere fast. And, you look at it, you can understand that, you're watching wheat trade a little bit higher. And I think that was a lot of short covering that hit that market. Corn and beans just kind of waffled back and forth. And, soybeans more so on the lower side because of improving weather forecasts for Brazil. But yeah, it just seemed like this market was starving for some information to help give it some direction.
Yeah, and of course, we have been kind of sideways in the grain markets for a little while. But if we do comparisons from last year to this year, let's talk a little bit about that. I've got corn down 30%, soybeans down 14%. And that should be of no surprise to anybody as we had this commodity reset from 2022 to 23.
Yeah, that's right. I mean, and we had, better production than expected. We had lower exports. So all that came into play to kind of push the market lower. The drop in corn at 30%, that's the largest yearly percentage drop in, I think, 10 years. So, I mean, that's pretty significant when you look at the corn market. But when you get a 2 billion bushel ending stocks estimate, corn really doesn't need to do a lot.
Right. So right now, what we're seeing, the setup is way different than last year for both corn and beans in terms of we've got carry in the market. We did not have that last year, did we?
We didn't, and of course, then, as you have more stocks available and stocks increasing, you get a carry in the market, which gives you an incentive to store and look at marketing, further down the road. And right now, that's what producers should be looking at, is taking advantage of that carry, especially in the corn market. Soybeans, I would say that, we probably are going to look at wanting to market soybeans in the next month to 6 weeks before Brazil starts dumping theirs on the market. But for corn, look out to that May, July timeframe and look at grabbing that carry.
Right. Same true for soybeans, you say, though?
Well, soybeans, there's enough of a carry, but I don't know if I'd want to push the soybeans that far out, because once Brazil gets a hold of the market and exporting, depending on how big their crop's going to be, we might see that it might take a little longer to get that market to come back after they start seeing exports slip over towards them.
Yeah. So corn and soybeans, basically, to get these markets to move out of these sideways ranges that we've been in, we're going to need some either supply or demand shock to the market, right? What would those be?
Well, that's a good question. Right now we're depending on the renewable energy or the renewable diesel, the sustainable aviation fuel to help kind of carry the soybean market and the vegetable oil market in general. And right now it's been a little slow in going. Bean oil had a pretty rough year this year, actually dropping, but yet we're not exporting anything. We're using most of our soybean oil for making the renewable diesel. So I think that's the next big thing that we have to watch for as far as soybeans are concerned. For corn, we need to get some exports, or we need to either increase feed demand. And right now, it doesn't look like we're increasing our livestock sector.
Yeah. And when we talk about exports, really the big gorilla is China, isn't it?
It is China, and looking at it, they're down big from last year as far as what their purchases are for both soybeans and for corn. It doesn't look like we're going to see much of an impact as far as the corn is concerned. And a lot of that will depend on what happens with the safrinha corn crop after the first of the year. Will the producers in Brazil harvest the soybeans, and will they follow up with the second corn crop? Or will they, because of late planting, forego planting corn? That would help bring some demand to the U.S.
So that's the demand shock. The supply shock would have to probably come from South America. And is it likely that after the first of the year, that is going to start getting even more attention?
I think it will. I mean, because they're starting to harvest the soybeans right now in Brazil. So we're going to start to hear more news of it. We're going to start to hear, lower yields. I do think it will come by the time we get to the middle of January. We'll start to see a lot different news coming for corn than what we're seeing now.
Okay. And let's also talk about the wheat market. Okay. KC wheat for the year down 27%, Chicago down 20%, Minneapolis down 22%. And of course, let's talk about some of the factors that have kind of pushed us that direction here.
Well, the big one, of course, is the huge production out of Russia and the fact that they're just commanding the export market. That certainly is causing some of the trouble. The other was a better than expected crop for the winter wheat and spring wheat. I mean, nobody expected that we were even going to see a spring wheat harvest or much of a production because of the hot, dry conditions we had in June and early July. But crop came in a lot better than expected. So we had a lot more supply than we were looking at. And again, we're not competitive in the world market on the exports, and that really hurt our exports this year.
Plus, funds have been short this market most of the year. And we have also seen, you talk about the lack of demand, that the demand picture has really been part of it because of Russia too, hasn't it?
Oh, most definitely. Russia and Ukraine. And Ukraine's actually, even though they're down from last year, they continue to move grain through their system, and that certainly is causing a little bit of pressure into the market. Our stronger dollar earlier in the year didn't help us, but now we're starting to get to become a little more competitive. So hopefully, once we get to the first of the year, we can continue to see the dollar drift a little bit or weaken, and that might help bring some demand back to the U.S.
Yeah. And of course, the Black Sea news, we kind of got numb to that, didn't we, from a geopolitical standpoint?
Yeah, we kind of did. I mean, we continue to see escalation in the war, but yet the market doesn't do anything with it. We get little blips, but nothing of anything major. We're even starting to hear of Russia now talking about slowing down exports a little bit because of the trouble they're seeing in the Red Sea and also in the Suez Canal. So everybody's starting to see a little bit of issues with moving wheat at this point.
Yeah. And when we look at some of the big picture items that probably impacted grains, maybe the entire commodity sector, we mentioned transportation. That was one of them, with the drought, Mississippi River, water levels low, you name it, Panama Canal. The other one was what was going on with the interest rate climate, the impact that was having on money flow into and out of the commodities, right?
It was, and of course, yeah, interest rates increasing, and that slowed down a little bit of movement. Our dollar was, seeing some strength. That caused a little bit of trouble. Now we're starting to come out of that, and hopefully that'll help bring in some extra, a little bit improve our demand picture. But then we're also now seeing the stock market rally, which is, I think, pulling some money out of the commodities and bringing it back into the stock market.
Right. Okay, look at livestock here. Live cattle up 7% for the year, feeder cattle up 20%. Do you think we're going to go back, even though we've had a big correction here? Now, are we going to retest highs again in 2024?
I think we have an opportunity to, but I would expect that we'll see a test of the lows that we hit, or at least see this market sell off and test the fortitude of the longs that have been coming back into the market. But I think once we see that cattle inventory report at the end of January, I would expect that's going to continue to show very tight supplies and shrinking herd. And I think that will help push the market back up again. I don't know if we can go back to the highs, but I think we should make a good test of them.
Yeah. And hogs, we were down 22% for the year. A lot of that just had to do with too many hogs, right?
No, that's exactly it. And, that was confirmed in the Hogs and Pigs report, where we're looking at just about every one of the weight categories up 1% to 2% more than expected. And, not so much on the kept for breeding number was a little bit lower, but the number of pigs and the farrowings was where we saw the bigger numbers.
All right. And we're not going to get out of those numbers for a while here. So probably anticipate a little pressure in the hogs for a while. Overall, in the meat sector, demand side of the equation, Randy, what are you seeing economically, and how may it impact consumers and their ability to buy meat in 2024?
Well, I mean, that was part of what turned the market, is that we just got too high, especially on the beef side, and that added to the pressure that came into the market. I think if we can kind of hold prices down, not quite see them go back up that high, with the improving economy, with the unemployment numbers down, and with the stock market rallying, and the idea that we could see interest rates decreased in the March report, that seems to be the consensus. I think we could start to see the demand, U.S. demand, pick up a little bit.
Yeah. And you mentioned the stock market hitting new highs. What do you see as we go into 2024 in terms of interest rate climate? Fed paused here, but will we see declining interest rates? What does that mean for the commodities sector? What does it mean for the stock market? Because we are at these all-time highs.
Well, right now, like I said, the idea is that the Fed is going to lower the interest rates in the March report, or their March meeting. I wouldn't expect them to do that. I actually look for the Fed to leave interest rates unchanged all the way through, at least through the June timeframe, the first 6 months, just to make sure we get down that 2% inflation rate that they're looking for. and then we could start to maybe see things tighten up on the interest rate side. But I think that could be a little negative to the market, as most are anticipating rate decreases coming sooner.
Yeah, we'll be keeping an eye as well on what goes on with crude oil and how that impacts inflation. That's a big part of that too, isn't it?
Oh, that's a huge part. And that the fact that crude oil dropping has really helped.
Absolutely. All right. Good to talk to you here. Have a happy new year, Randy, and thanks for joining us here. Randy Martinson, Martinson Ag, that is Markets Now.